Welcome to Accounting with Arpit Garg. Today we are going to start part 3 of Fundamentals of Partnership. Before proceeding, I hope you have gone through our first two classes. If not, then the link is given below in the description box. I suggest you to watch those first and clear your basics. I would like to thank all the students for praising the class and especially to those who are watching full session and giving their reviews and doubts. And one of you posted a doubt on last video, that is to explain profit sharing. I would like to remind you that I did not explain current account in previous class, so both these things will be resolved today. As we have completed our basics, so now we have to study accounting of some topics. The topics to be covered are partners capital account, interest on capital and current account, interest on drawing, partners remuneration, that is salary, commission, etc., transfer to reserve, guarantee of profit, and past adjustment. As we are going in detail, so we will go slow and study and understand the topics in depth. For this, today we will be covering only first two topics, that is partners capital account and interest on capital and current accounts. Let's begin. Our first topic is partners capital account. Remember what is capital? Capital is the money contributed by the owner in its business. Here we will be studying the methods of preparing capital accounts. In partnership, we have two methods of preparing capital accounts. First, fixed capital account method, and second, fluctuating capital account method. Now what these two methods says. Suppose we all are starting a business in partnership, and you can understand that when we will start our business, some part of our capital will get blocked, that is in our fixed assets, and that part of capital cannot be withdrawn in the life of business except in the event of winding up. So that part of capital which is fixed is accounted separately, and other part which is of day-to-day working or regular nature is accounted separately in fixed capital account method. While in fluctuating capital account methods, as the name says, fluctuating means changing, so only one account will be maintained, which will change itself on every entry. So the accounts to be maintained under fixed capital account method are partners capital account and partners current account. The account to be maintained under fluctuating capital account method is partners capital account. Let's see in detail which all items these accounts will be covering. As we have only one account in fluctuating method, so first we will study that. We have opening balance, additional capital, drawings, interest on capital, interest on drawing, remuneration, profit or loss, and our closing balance, that is our balance sheet. I hope we all are thorough with all these topics and have a basic idea of this. Then, as here we can understand that if a business is following either fluctuating capital method or fixed capital method, that will not discriminate their entries because the transaction of business will remain same. So these items being same will only be bifurcated or divided between two accounts in fixed capital account method. Now, as we have opening. So both the accounts will have their opening balances, that is balance BD. Next, additional capital will be transferred to capital account. Drawing will be shown in both the accounts. Yes, but we will explain it later how this is done. Then, interest on capital, interest on current account, interest on drawings, remuneration, profit or loss, and yes, at last our balance CD, that is closing balance of both the accounts. Now, one point left here is drawing. Drawings is of two types, that is drawing against capital and drawing against profit. I haven't written anything here in detail because these topics will also be covered in our next lecture of drawings. So here we just need to understand the basic, that is drawing against capital means withdrawing a part of our capital. Suppose A, B and C are partners and their capital contribution is rupees 5 lakh each. So their total capital comes out to be 15 lakh. But now they think that the business can run with rupees 12 lakh also, and they are having rupees 3 lakh as extra. So they decided to withdraw rupees 1 lakh each from the business. While withdrawing the 1 lakh, they reduced the capital of business. So that is drawing against capital and will be shown under the head capital accounts. While every business earns profit, or we can say that every businessman works to earn profit and he needs that part of profit to maintain his household expenses. So, whenever a partner withdraw amount from profit, that is drawing against profit and is shown under capital accounts. Please go through these accounts carefully and see whether you can connect with all the particulars or not. This drawing against capital and drawing against profit will also be explained in our next lecture. Yes, here comes a doubt that balance BD is given on both the sides and balance CD also in both these sides of partner's current account. See, here we need to understand that in partner's capital account, credit side will increase the capital and debit side will decrease the capital. So, to decrease the capital, we have only one option, that is drawing against capital. And we have already studied that no one can withdraw fixed capital from business except in the event of winding up. So, this two cash or bank accounts amount will never be more than balance PD and additional capital. So, partners capital account will never have a debit balance. But in partners current account, we have second last item, that is to profit and loss account, which means if a business has earned too much of loss, so it will cover or it will consume all the amounts written on credit side. So the expense will be more and our balance CD will come on debit side. Once again, as in capital account, we cannot withdraw whole of our capital except in the event of winding up. So the capital balance can never be zero or negative. But in current account, as we are transferring loss and the amount of loss can be anything and even it can be more than all the expenses and appropriation and our capital balance, or we can say the current balance. So this amount of loss will make our capital balance as debit. Please go through this account also, that is partners capital account under fluctuating capital account method. Okay, now let's try to solve a question to brush up the concepts we have studied so far and also to clear our doubt of sharing of profit. I request you to write down the question on a paper so that you can solve it with me. Written? Okay, let's read it at once first. A and B are partners with capitals of rupees 1 lakh and 1 lakh 50,000 respectively on 1st April 2018. A also gave loan to firm for rupees 20,000 and 1st October 2018. Net profit for the year ended 31st March 2019 was rupees 75,000 before charging interest on loan. The partnership deed provides for the following. A is entitled to a salary of rupees 6,000 per annum. Interest on capitals is to be allowed at the rate 8% per annum. Interest on drawing is to be charged at the rate 7% per annum. Drawing of a partner A and B were rupees 12,000 and 10,000 respectively, and interest on drawings for A being rupees 300 and for B rupees 250. Pass the journal entries for the above and show how profit will be divided between A and B, and also show the capital accounts of the partners if they are fixed and second if they are fluctuating. Okay, but I am going to solve this question only according to fixed method. Second part of this question, that is according to fluctuating method, you please solve by yourself, as there is nothing changed in that except for the opening balance of capital. Let's begin. Now, please make the format of journal entries of 2 pages at least, then a format of profit and loss appropriation account, a format of partners capital account, and just like partners capital account, make another format of partners current account also, but a slight lengthier one than this. Done? Okay, let's begin stepwise. Please look at the question with me and solve it yourself. A and B are partners with a capital of rupees 1 lakh and 1 lakh 50,000 respectively on 1st April 2018. As it is our opening date, so it means these are our opening capital. So this will be transferred to the credit side of partners capital account. So 2018 April 1st to balance BD 1 lakh and 1 lakh 50,000. Next, A also gave loan to firm for rupees 20,000 on 1st October 2018. Net profit for the year ended 31st March 2019 was 75,000 before charging interest on loan. See, as it is written here that interest on loan is not charged, so now we need to charge it. And second point, that interest on loan is not given, so we need to see what will be the rate of interest to be charged. So as we have read a point, that is provisions applicable in absence of partnership deed. There we read that interest on partner's loan is to be provided at the rate 6% per annum if partnership deed is silent. So here amount of interest will be 6% of rupees 20,000 for 6 months from October to March. So our entry will be as interest on loan being our expense will be debited, and as it is not paid, so it will increase our liability. So it will be credited to A's loan account. Student, please write the solution with me. Next, as interest on A's loan account is of nominal nature, it will be transferred to profit and loss account being charged against profit. So our next entry is profit and loss account debit to interest on A's loan. Then we can see that our net profit was rupees 75,000, but after charging interest on loan it will be reduced by rupees 600 and will come down to rupees 74,400. And as this is profit, so now our profit and loss appropriation account will be credited. So entry is profit and loss account debit 74,400 to profit and loss appropriation account 74,400. This entry will be posted to ledger account like by profit and loss account 75,000 less interest on loan 600, so 74,400. Next, the partnership deed provides for the following. A is entitled to a salary of rupees 6,000 per annum. So, salary being our expense will be debited. So, A's salary account debit to A's current account rupees 6,000, 6,000. Then this will be transferred to A's current account as by A's salary rupees 6,000. Then closing entry profit and loss appropriation account debit to A's salary account. And now this entry will be posted to profit and loss appropriation account on debit side as profit and loss appropriation account is debited in journal entry. So on debit side we will write to A's salary account rupees 6,000. Students, if you are facing any problem in understanding, then you can please comment below, or first you can rewind the video and watch it once again. Next, interest on capital is to be allowed at the rate 8% per annum. So interest on capital being our expense will be debited. So interest on capital account debit to A's current account to B's current account. A's capital is rupees 1 lakh, so 8% of rupees 1 lakh is 8,000. 8% of rupees 1 lakh 50,000, so for B is rupees 12,000. So interest on capital account debit 20,000. This again will be transferred to partner's current account on credit side as interest will increase their capital as they are getting this. Then closing entry interest on capital account will be credited and we will debit profit and loss appropriation account. Or you can also say that as it is our expense, so it will be shown on debit side of profit and loss appropriation account. Next, interest on drawing is to be charged at the rate 7% per annum. But as I told you, we are given the absolute amount of interest on drawing, and also we haven't studied the calculation of interest on drawing. So here we will take rupees 300 and rupees 250 for our accounting. And as interest on drawing is our income, so it will be credited. So here interest on drawing account credit rupees 550, A's current account debit rupees 300 and B's current account debit rupees 250. And as we are taking this amount from A and B, so it will reduce their capital. And we have studied minus plus minus, which means to decrease a credit account, we need to debit it. So here it will be posted on the debit side. Then, as interest on drawing account is credited here, so in closing entry, we will debit interest on drawing account and credit profit and loss appropriation account. And as we can see, interest on drawing is income for the firm. So, income it will be credited to profit and loss appropriation account. Then we are given the drawings rupees 12,000 and 10,000. So we will record these as well. So partners drawing account A 12,000, partners drawing account B rupees 10,000, to cash or bank rupees 22,000. Then this will be posted to partners current account on the debit side. But before posting, we will reduce their current account by passing one more entry, that is A's current account debit to partners drawing account A 12,000 12,000. Now it will be posted because earlier in our previous entry, as you can see, there is no partner's current account debited or credited. So we cannot post this entry directly to partner's current account. That's why we posted this entry partner's current account to partner's drawing to post this in partner's current account. Then we will post same entry for B as well. Now the partner's current account will be reduced by rupees 12,000 and 10,000 in ledger account. Then all the concepts are done. We are only left with the profit sharing. So now the profit left with us is rupees 48,950. From where did we get this amount? You can total all the profit and loss appropriation account amount. You will add all the credit balance and you will deduct debit balance from there, and you will get debit balance of rupees 48,950. Then we will post this to current account of partners as well, and this being profit will increase their capital, hence will be shown on credit side. Then, as we know, first ledger accounts are maintained, after that trial balance, and after that we come to our financial statement. So, profit and loss appropriation account will be prepared later on. So, first we will close our partner's current account by passing closing entry, that is March 31st to balance CD rupees 26,175 and rupees 26,225. Then we will find out the balancing figure of rupees profit and loss appropriation account. I know we already have taken this amount as 4 48,950. But see, in exam, if you are given to prepare only profit and loss appropriation account without making journal entries, so then how we will find this amount? Then add rupees 74,400 and rupees 550, then minus rupees 6,000 minus 20,000, and you will get rupees 48,950. Now, in question, we are not given the profit sharing ratio of the partners. Now, this point also we studied in provisions applicable in absence of partnership deed, that if profit sharing ratio is not given, it will be considered as equal. So we will divide this amount in both the partners equally. So 48950 divided by 2 will give 24,475 and 24,475. Then you can please add all the columns and write the total below. That's it. I hope you understood the question. If not, you can please rewind the video and watch it once again to make the concept clear stepwise and see how we break the question and move strategically to every step and solve one concept everywhere. For example, I read concept of salary. So salary I posted journal entry. Then same entry was posted to current account. Then that salaries amount will be transferred to profit and loss appropriation account, and from that we posted it to profit and loss appropriation account also. Likewise, we will solve all the entry stepwise. Then please solve the question according to fluctuating capital method. I hope everyone can do that because there is no change. Only in place of current account, we will write capital account, and the amount we wrote in our capital account, that is to balance BD rupees 1 lakh and 1,50,000, will not come in current account, will come in the partner's capital account. Or we can say that all the amount of current account will be transferred to capital account. Okay, now let's start with the next topic, that is provisions relating to interest on capital. I know we have studied this, the provision that if it is given in partnership deed, then we will provide interest on capital, and if it is not, then it is not allowed. But here we are going to study this in detail. So, first we will check our cases and then our provisions. So, first case is if partnership deed is absent or silent. Yes, then we will not allow any interest on capital. Second, if partnership deed says that we need to provide interest on capital but did not tell about the treatment, whether it is charge against profit or appropriation of profit. In that case, we will check if we have got loss, then it is not allowed. But if we have earned profit and that profit is more than the interest, or we can say the more than the appropriations, then it is allowed, as we are having the sufficient amount to distribute. If profit is equal to interest, then also it will be allowed. But if profit is less than interest, then it will be given proportionately, that is in a ratio. For example, A is to get rupees 10,000 and B is to get rupees 20,000. So total we need to distribute rupees 30,000, but we are having only rupees 15,000. So we will give half amount to each of them, that is rupees 5,000 and rupees 10,000. Next, third point, if partnership deed says that we need to give interest on capital and that too as charge against profit. So in any case, whether there is profit or loss, we have to give interest on capital. Please note 2 points here. If question does not specify whether interest on capital is an appropriation of profit or charge against profit, it is assumed that it is an appropriation of profit and hence will be shown in profit and loss appropriation account. Second, interest is to be allowed or charged on partner's current account only when instructed in question. So if you are given to allow interest on capital account, then you will allow interest only on capital account. You will avoid allowing interest on current account and you will be able to clear the concept when you will solve the questions. I request you all to please contact your friends or seniors to provide you with maximum number of questions so that you can solve them and brush up your concepts simultaneously as we are studying the concepts. That's it for today. If you like the video, please subscribe the channel and press bell icon to receive all latest updates. You can comment your queries below and I will try my best to solve all your problems in next session. Thank you. This is Accounting with Arpit Garg signing off. Bye bye. Take care. Stay safe. Keep learning. Jai Hind.